Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So we've had some volatility to end the year this past week, but if you take a step back, the fourth quarter has been incredibly strong, and we've had historic flows that have broken previous records set after COVID for total equity fund flows over the past couple months. Equity market concentration is a big theme in 2023 in terms of the Mag 7 and their market cap concentration. But if you look at the fundamentals, perhaps 2025 is going to be more of the same. And finally, the big news this week to end the year, the Fed did cut interest rates as expected, but when you looked at their forward path over the next 2 years, markets interpretation and what the Fed is telling us, they're not going to cut as much as previously expected, and their expectation for inflation is actually to remain elevated for longer than the market had previously expected them to believe. Equity market volatility spiked pretty significantly from that. So this chart shows the rolling 9-week flows into US equity ETFs and mutual funds in billions. So you can see nearly $200 billion have been flowed into equity ETFs and mutual funds over the past 2+ months. And that surpasses the previous record of around 150 billion that was set during the second half of 2020 after the economy reopened. We had that massive flood of assets come back to risky assets like the equity market. So a lot of this happened post election after Trump won the presidential election. We've had a nice rally, but we have seen a little bit of a slowdown in volatility, and we'll talk about that in a moment. But one of the other big themes of 2023 has been the concentration of the Mag 7, taking up more than 30% of the S&P 500, these seven stocks alone. But if you look at 2025 and the fundamentals, this is a look at the Magnificent Seven, right? These are the big tech companies that we all know, whether it's Tesla, Microsoft, Meta, Google, and so on. NVIDIA is a big one too. This looks at the expected net income growth for those seven companies, and then the expected net income growth for the 493 other companies in the S&P 500 if you exclude those seven companies. And it's a pretty drastic difference, and this kind of shows you why they've been earning their way to the concentration. Valuations are high, but it's not extreme because they're earning a lot of money. They have a lot of cash. You can look at the fourth quarter of 2024, first quarter and second quarter. One thing you can notice is it's not as strong as it was in 2024, that disparity, but it's still between 17 and 21% growth rates are expected next year, 17 and 21% rather. And in some cases, it's 50 to 100% higher than the rest of the companies. So that margin is not as large as it was back during 2023 and 2024, but still significantly expected to outperform in terms of earnings over the next 12 months. Now, this week, the Fed, at their final meeting of 2024, decided to cut interest rates 25 basis points. The new Fed funds target rate, remember, this is the overnight lending rate that banks can lend to each other at the Fed central bank. They dropped it from 4.75% upper bound down to 4.5%. So the Fed funds rate is at that 4.25 to 4.5%. That is the third consecutive cut. Remember, they started with the 50 basis point cut, and then we've received two 25 basis point cuts since then, moving from 5.5 all the way down to 4.5 over the past few meetings. The big news, because that was expected, that 25 basis point cut, the big news was their expectations going out. They now went from expecting 4 rate cuts in 2025 to down to 2. And they looked for inflation not to hit their target until 2027. That's much later than expected. The good news is that they did not believe there would be a recession in terms of their forecast in 2025, which is in line with some of the data that we look at as well. But if you look at the Fed fund futures curve, this is the expected Fed funds rate. We have two different lines to compare. One looks at 12/31/2023. So this was the curve all the way back at the beginning of 2024. And today, you can see the longer end has moved higher, and we've seen this move a little bit higher even the past couple weeks, with the expectation the market did not like it. We've seen the S&P 500 decline by nearly about 3.5% or so following that Fed meeting. because interest rates are expected to stay a little bit more elevated and inflation to perhaps remain higher based on the Fed's interpretation of data. We saw that decline in equities. We see volatility. This is the VIX. This is a SIBO 30-day expected volatility annualized. You can see it surged to above 25 for the first time since the August 2024, when we had that a little bit less than 10% pullback in the markets. But you can see equity market volatility went from 13 to north of 25, 26 in just a matter of days in response to this. So equity market volatility was very subdued. This event caused a lot of investors to sell some of the securities after the strong run up before the end of the year. So before we end it, do not let the Grinch steal Christmas. I thought this was a pretty humorous picture of Mr. Powell done by, I think, an artificial intelligence. Pretty nice. So, no, we love you. We love you, pal. So this is nothing against you, but don't let the Grinch steal Christmas. I want to thank everyone who is a regular watcher, or if this is your first time, welcome to the Markets in Focus and Meeder family. We are here every other week on our YouTube channel and constantly looking to put out content that is value add. And we really do appreciate your viewership. For all those clients and advisors that are partners and investors in our products, we want to thank you as well. And I wish everyone a wonderful Christmas and a happy holiday season and a very, very happy new year. And I will see you next year and talk to you next year. Thanks.